Expert joining us now. Dehn of Ashmore Investment Management is with us. Jan, good morning to you. Thank you very much for joining us. Well, the Reserve Bank cut interest rates yesterday by 0.25% and even appeared to indicate that it will settle for a lower neutral rate, which means some more cuts are in the offing. Your comment as an investor?
Yeah, I think that was the right decision. We were certainly expecting that. There's a more benign outlook for inflation. The rains have been decent. Food prices are sort of moderating, and real yields are high enough given the inflationary risks. So I think this was a sensible move. I think there's also a supportive backdrop in the global currency markets in favor of EM currencies in general. And I think Indian bonds and Indian equities offer upside. So we should expect a relatively positive, supportive environment from international investors coming into the Indian market.
Jan, hi, good afternoon. So in that case, what do you think the rate cuts will do to the economy, and what would be on your buying list?
Well, actually, the environment is kind of favorable for both here, with the inflation environment moderating and the market sort of getting used to the new monetary policy committee. I think there is a case for supporting fixed income. But I also think that the consumer story is beginning to pick up. We're seeing this in the demand for vehicles. We're seeing it in the demand for two-wheelers. And we're seeing it in the consumer credit numbers. In addition to that, we have some technicals playing into the equity market, particularly the National Pension Fund beginning to allocate more to equities, which I think is supportive. And the consumer story also supports it. So I think we're sort of in a Goldilocks environment where both bonds and stocks are going to do reasonably well in the near future. The main risks to that are going to come from abroad. As we get close to year end, there is going to be the usual position squaring from international investors. People are going to focus on the possible Fed hike in December, and of course we have the US election. But these are really non-Indian risks, so not something we should be particularly worried about.
I'll nevertheless come to the global cues in a bit, but first, what earnings growth are you expecting, and therefore what valuations will you give? For that matter, are you comfortable with current valuations?
Valuations in the Indian stock market are stretched, I would say. So I'm not expecting a massive and dramatic rally, but I do expect that we're going to see sort of a slow, gradual grind higher. And the reason for that is that I see a better earnings outlook on the back of more consumption-led growth going forward. That should support stocks, particularly in the consumer-sensitive sectors, the more cyclical sectors. There are other sectors in the economy, the more investment-related, traditional heavy investments such as power, roads, ports, infrastructure, that sort of stuff, energy, where unfortunately there still are quite material leverage issues, and where there are also material NPL issues in the banking system. And until those issues are properly addressed, I think the consumer story is the main one that's going to be driving the story. And for that reason, I would really focus on sectors that bypass those heavily levered sectors.
Okay, but three legs to the financial sector then: public banks, private banks, and non-bank financial companies. Let me come to the ignored piece, PSU banks. Are you buying any of them?
Very selectively, and only when they become particularly cheap. I think there was a quite deliberate choice made at the top level of government between recapitalizing the public sector banks or seeking passage of the GST bill. And I think that was quite a deliberate choice. And I think ultimately it was the right choice to go with the GST bill. But that does leave us with a public sector banking system that really has some underlying structural problems that need to be addressed. And we still need to see whether that becomes a priority for the government. There is talk of setting up perhaps a bad bank. I think that would be a very good idea. And I think that's really the sort of main thing holding back the Indian economy, is that we do have this NPL problem that particularly affects the public sector banks. So my inclination is definitely on the private side. selectively choosing the ones that have the best balance sheets because they're the ones who are going to be able to expand lending and take advantage of the move in the consumer sector.
Okay. Well, let me come now to the global piece. There is skittishness at higher levels with high equity valuations exactly at a time when yields are negative in these very countries or some of these countries. What kind of global jitters you see, and when might this impact the equity party?
There are multiple global threats. I'm afraid that the developed economies are looking more and more like freak shows. Their asset price valuations are dramatically distorted by years of QE. There's been a complete neglect of economic reforms. Central banks have practically no policy tools left in the event of a downturn in the economy. They're heavily indebted, they can't grow, and productivity is very low. So by far the biggest risks for the global economy is if one of the big developed market regions experiences major macroeconomic problems such as a recession, or of course if one of the European financials go belly up. This would definitely have a negative effect on sentiment globally and therefore also tend to affect flows into emerging markets. But I think emerging markets have been through an incredible amount of headwinds and gone through them very successfully despite the magnitude of these headwinds over the last 4 years. If you think about the taper tantrum, pricing in the start of the Fed hiking cycle, a 50% rally in the US dollar, and a big fall in commodity prices has really been, 4 major headwinds for EM. And EM has come through that, partly because they've done reforms and partly because they've not lost sight of relatively orthodox monetary policies. So there's a limit to how far the developments in developed economies can actually impact fundamentals. I think the technical position for EM assets in general, including Indian assets, is also quite good when you look at it from a foreign investor perspective. We estimate that developed market pension funds have halved their exposure to EM over the last 4 years. So they're all underweight emerging market assets. And that means that there's not a lot of selling when we have bad events, and potentially quite a supportive environment if investors begin to allocate back to EM, which we actually think is beginning to happen now.
Okay, finally then, what kind of one-year returns can you expect in India? Do you see the Nifty going back to its previous high of 9100 or even better, say 9400 or 9500?
I think we get somewhere in between those two, actually. I think we are going to head up toward closer to 9,400 than 9,100. I think we are on the cusp of a reversal of the global flows out of EM that we've seen over the last 4 years. And I think India looks extremely good in a global context here because it has a strong reform record. It's moved up a lot in the global competitiveness index because of the efforts to reduce red tape. And the macroeconomic story looks very solid. So I think we could well see the big surprise factor over the next 12 months or so could be the resumption of more significant flows from abroad into India. And that could easily be the sort of the factor that pushes us up towards the high end of that range.
Oh, that's a pleasant conversation for an India investor. Thank you very much, Jan Dehn, for joining us and for spreading so much optimism in investor hearts. Well, at the moment, anyway, optimism is at a very high level, especially in the mid-cap space. We will take a break on the note. When we come back, we are going to get you